it is a sucker punch to the guts of American retirement investors, plain and simple.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. Recently, the Department of Labor's Employee Benefits Security Administration announced that it has rescinded its 2022 guidance that discouraged fiduciaries from including cryptocurrency options such as Bitcoin in 401k plans. The move is seen as a removal of a big regulatory roadblock that forced plan fiduciaries to exercise extreme care before adding crypto to 401k investment menus, in line with the Trump administration's expressed desire to eliminate what it sees as restrictive regulations or unnecessary government interference that hinders Trump's desire to make the U.S. a leader in global digital finance. Here to discuss the implications of this controversial move by the EBSA, we're happy to have Knut Rostad, co-founder and president of the Institute for the Fiduciary Standard, a nonprofit formed in 2011 to advance the fiduciary standard through research, education, and advocacy. Welcome to the 401k Specialist Podcast, Knut.
Thank you, Brian. I'm very glad to be here, and you've got a great topic for us to discuss. I'm looking forward to it.
Yeah, it's very timely right now with this recent move. Let's dive right into this latest development, which you were quick to call a plain awful decision regardless of what proponents say. Tell us about why you think rescinding the guidance is such a bad idea.
Well, because the guidance represents, both in very practical and legal terms and metaphorically, the core role of the Department of Labor. And what they rescinded was a warning that was quite appropriate for the issue at hand. And, it is a sucker punch to the guts of American retirement investors, plain and simple.
In the DOL's press release, Secretary of Labor Lori Chavez-DeRemer is quoted as saying, "We're rolling back this overreach and making it clear that investment decisions should be made by fiduciaries, not DC bureaucrats." Any thoughts on that take?
Well, that is just a yet clearer example of basically the current Secretary of Labor of abrogating her basic responsibility. And she does it in such plain and clear language that it's, on one level, it's sort of unbelievable, but on another level, is exactly what we see elsewhere in the administration regarding its views regarding regulation. When she says that these decisions should be made by fiduciaries, what she seems to forget that her role is to provide guidance on what fiduciaries should be doing in terms of making those decisions, as though the Department of Labor has no role, no function, no purpose whatsoever. So it is an absolutely awful decision without hesitation. But on the other hand, because it's so obvious and blatant what she's doing, it does serve a purpose of sending a signal to a lot of other people that should be concerned about the state of fiduciary, not just at the DOL, but elsewhere, starting at the Securities and Exchange Commission, frankly, and should send a very strong signal that, Houston, we have a problem. And that if you don't recognize it, it's only going to get worse. So, yes, it's a terrible decision, but it does serve a purpose that hopefully will be helpful as well.
Right. Okay. A lot of people in the retirement industry seem to think that while the DOL rescinding this previous guidance might make it permissible to include cryptocurrency in 401k investment menus, the vast majority of plan fiduciaries are still going to err on the side of caution and stay away to avoid potential fiduciary landmines from the notoriously volatile sector. Do you think there will be enough demand from participants out there to tempt plans to enter these high-risk waters?
First of all, I agree that many plan fiduciaries aren't going to touch this with a 10-foot pole, and that's a good thing. What we don't know is how many meet is, frankly, whether it's a significant minority or whether it's a significant majority or where else on the spectrum it sort of lands. But, in terms of demand for it, if plan fiduciaries and those that are good will absolutely do this, sort of instinctively, once they inform a plan participant what crypto is all about, the plan participant is not going to be very interested in it, I think, plain and simple. But, if a plan fiduciary could start to say, listen, Mr. and Mrs. Jones, if you seriously want to take a certain amount in your pension and put it into cryptos, here's my suggestion for you. Take half that amount and buy yourself a very fancy trip to Las Vegas and gamble all you want to do, because you'll lose less money and you'll understand what cryptos are all about in a more meaningful way.
Wow. Okay. That's an interesting take. Great. So plan sponsors considering this need to evaluate whether offering such investments aligns with their duty to act in the best interests of participants. What are some of the primary risks that they need to be considering?
Well, the Department of Labor in 2022 sort of, I think, identified the primary risk pretty succinctly and pretty clearly. You can start with volatility, and to the extent that this is a speculative, I don't even want to call it an investment, because in any traditional sense of the meaning of the word, it's not an investment per se. And then we could add to that the opacity involved with these instruments. And then we could add, and without getting too deep in the weeds, how they are not custodied anywhere where you can look at them and see what the value of them is at any given time. So it's, again, think about the weekend in Vegas and get it out of your system. They'll be better off.
So instead of stronger federal oversight of cryptocurrency and retirement plans and robust measures to safeguard participants, it appears we're headed in the other direction during the second Trump administration. The same kind of goes for another recent issue where the administration is looking to make it easier to allow private equity investments in 401k plans. How do you think this all might shake out during the next 4 years?
I fear that the direction we see this administration going into right today, as of June 2025, is going to continue for the next 3.5 years. There are events that could change that direction. One is the type of event that we don't even want to consider, because that would make the last crash of the stock market look like a Sunday walk in the park. But in the context of what realistically could happen, we could see a majority of the members of the United States Senate get some backbone and start putting the brakes on some of what we're seeing here. And so, barring that type of interference with this administration, I think the roller coaster ride is just beginning, I fear.
Okay. Well, while we have you on the podcast, of course, we have to ask you about the status of the Department of Labor's latest fiduciary rule, which has been stuck in some sort of legal purgatory since the court put stays on the rule and the DOL has asked for more time for its new leadership to figure out how they want to proceed. What's your take on what might happen next, and what do you think should happen next with that?
Well, what I fear might happen is continuation, what we saw in the version one of this administration in terms of their treatment of the DOL rule. Um, but let me add something to the prior question in terms of what else could interfere with the direction we're going in now, and that is a decision out of the Supreme Court, for example, that really upends the direction that we're going in right now. And as you know, Brian, there are a number of people that believe that's actually possible. We don't know what's going to happen, particularly in the next 30 days, much less the next 1 or 2 years. But that could also upend the direction that we're going in a very positive way. So that's something to keep in mind, I think.
Well, it's been very interesting talking to you and getting your perspective on this. I really appreciate it. Knut A. Rostad, founder and president of the Institute for the Fiduciary Standard. Thanks for joining us today and sharing your insights on this hot topic on the 401k Specialist podcast.
Well, thank you, Brian, for having me, and thank you for covering this issue, because, as you know, it is extraordinarily important, and these are not normal times that we're living in. I think we need to remind people these are not normal times, and I think that's awfully important. So thank you very much.
All right. Thank you.